Hey guys, it's Brian. Welcome to Financial Fitness. If you're new to the channel, please subscribe. In this video, I'm going to be talking about what a health savings account is, who they're suitable for, and the pros and cons of health savings accounts. Let's get started. A health savings account, or HSA, is a tax-advantaged account for individuals covered under a high-deductible health insurance plan to save money for qualified medical expenses. It is also one of the few triple tax-advantaged account types that are available in terms of investing or savings accounts. The only other one that comes close to triple tax advantaged is a 529 savings plan, but only under certain circumstances. Contributions are made into the account by the individual or their employer and are limited to a maximum amount each year. The 2021 HSA contribution limits are $3,600 for a self-only account and $7,200 for a family account for people under the age of 55. The annual contribution limits apply to the total amount contributed by both the employer and the employee. Catch-up contributions of an additional $1,000 can be made to their HSAs for individuals 55 years or older by the end of the tax year. The contributions can be invested over time if the balance in the account is above a certain amount, typically $1,000 or more. The amount saved within an HSA can be used to pay for qualified medical expenses, such as medical, dental, vision, and prescription drugs. Any other person, like a family member, can also contribute to an HSA of an eligible individual. To be eligible to open an HSA, you would have to have a high-deductible health insurance plan, have no other health insurance coverage, not be enrolled in Medicare, not claimed as a dependent on someone else's tax return. High-deductible health insurance plans have higher annual deductibles, and the plan pays nothing until you reach the deductible, but offer lower premiums than other health insurance plans. The financial benefit of the low premium and high deductible structure depends on your personal situation. If you're young and just started working and very healthy, it could make sense to consider a high deductible health insurance plan if you do not see doctors that often, especially if you have an employer-sponsored plan where they can contribute or match some of your contributions into an HSA. During the year when paying for qualified medical expenses equal and up to a plan's deductible amount, additional qualified expenses are divided between the individual and the plan, with the insurance company paying somewhere between 80 to 90%, and you would pay the remaining 10 to 20% or a copay. Once the annual deductible is met in a given plan year, any additional medical expenses are typically covered by the plan, with the exception of any uncovered costs as stated in the plan contract, like copays. You can withdraw money accumulated in an HSA to cover these out-of-pocket expenses. Self-employed or unemployed individuals can also contribute to an HSA as long as they meet the 4 requirements I just listed. The minimum deductible required of a high-deductible health insurance plan in order to open an HSA is $1,400 for an individual or $2,800 for a family for 2021. Some pros of an HSA are triple tax advantaged because contributions are not subject to tax, the money can be invested and grow tax-free, and withdrawals are not taxed as long as you use them for qualified medical expenses. They can be used or saved indefinitely without a required withdrawal time frame because they roll over every year. Funds in the HSA that aren't used in the near future or current year can accumulate and grow while being invested in stocks and other securities, which can potentially lead to higher balances over time and used on medical expenses during retirement. HSAs are portable, meaning that if employees change jobs, they can still keep their HSAs. An HSA plan can also be transferred to a surviving spouse tax-free upon the death of the account holder. Employer contributions and an individual's contributions through payroll deduction into an HSA are excluded from an employee's taxable income. An individual's direct contributions to an HSA are 100% tax deductible from the employee's income. Growth from investment earnings in the HSA are also tax-free. Distributions from an HSA are tax-free as long as the money is used for qualified medical expenses based on IRS guidelines. Distributions used for medical expenses that are covered under your high-deductible health insurance plan are included in determining if your plan's deductible has been met in any given calendar year. A portion of the annual premium for a qualified long-term care insurance policy can be paid for using funds from an HSA. Some cons of an HSA are excess contributions made to an HSA incur a 6% tax and are not tax deductible. The main drawback is that you need to be a good candidate for a high deductible health insurance plan and in a position where you can financially afford the high deductibles and can benefit from the tax advantages of an HSA. HSAs have tax filing requirements for contributions, specific rules on withdrawals, distribution reporting, and overall record keeping may be difficult or a hassle to maintain. Low maximum contribution limits per year. If you fund your own HSA either through payroll deductions or directly, you should be financially capable to set aside enough to cover most or all of your health insurance plan deductible. If you don't have enough money to set aside in an HSA, you may find the high deductible to be more trouble than the tax benefits of having an HSA. Insurance premiums don't count as qualified medical expenses unless the premiums are for Medicare. Premiums for Medicare supplemental or Medigap policies are not treated as qualified medical expenses. Withdrawals from HSAs are tax-free as long as they are used to pay for qualified medical expenses. If distributions from an HSA are used to pay for anything that is not a qualified medical expense, those distributions are subject to both income tax and an additional 20% tax penalty. If the designated beneficiary is not the account holder's spouse, the account no longer is treated as an HSA. The beneficiary is taxed on the account's market value, but is adjusted for any qualified medical expenses that had been paid from the account within a year of the date of death. To summarize, HSAs are one of the best tax advantage savings and investment tools available under the U.S. tax code. They are referred to as triple tax advantaged because the contributions, growth, and withdrawals are not taxed as long as you use any withdrawals to pay for qualified medical expenses. HSAs can be funded by the employee and the employer, and unused money can be rolled over into future years to be used at a later date. As people age, medical expenses tend to increase, particularly around retirement age and older. If you are suitable for starting an HSA at an early age and can afford a high deductible health insurance plan, contributing and investing it over a long period of time can contribute greatly to securing your financial and health-related future. Just make sure you don't fall into the trap of oversaving into your HSA for the tax advantages rather than taking care of your health. Theoretically, that can happen if you're already used to saving a lot normally. So if you're thinking about opening an HSA, think about how you plan to use it first, since they're not for everyone. It's pretty useful for the short term over the next few years to cover upcoming medical expenses you're anticipating, or for the long term to invest it and cover larger medical expenses like long-term care in the future, while also being able to cover some sudden short-term medical expenses. If you can't anticipate short-term medical expenses and/or have too many current expenses to contribute to an HSA, then you might be better off not having an HSA. Thanks so much for watching. I hope you liked this video and found it insightful. Click the like button if you did, and please subscribe if you haven't already. Click the notification bell so you can see when I post videos next. Feel free to leave comments, questions, and any topics you might want to hear about in future videos to get on track to being financially fit. See you in the next video.